Hi, I'm Harper Jones with Life with Leverage, and we coach people on the infinite banking concept and how you can become your own banker. Today, we're going to talk about how we design our policies for purposes of infinite banking, and I'm actually going to share my screen and walk through it today. So, as we go to the computer and look at it, this is a life insurance policy design. Let's go through the columns before we have any of the numbers populate. We're going to have annual premium at the far left. You'll see my cursor here. We're going to have the year, PUA in, as in your paid up additions rider that we put in there. Then we're going to have our paid up additions rider cash value increase. Then we're going to have the whole life base premium portion that we're putting in, the whole life cash value increase, and the annual cash value increase overall. And I'll go back over that in a minute. We're going to look at $100,000 premium. So this is suggesting we're paying in $100,000 each year. We're going to put 60% of that, approximately the $100,000, into the paid up additions rider. And we're going to approximately put 40% of that into the whole life base premium. Here are some acronyms at the top left corner. CV, or cash value. PUA is going to stand for paid up additions rider, or PUA premium. And the whole life is base premium. Now, to the far right, we got PUA is like turbo in a car, or like fuel you're putting on a fire to ignite it to get it going. And the whole life portion is like horsepower in a car that is really going to get it going over time. Now we're going to look at years 1 through 5 and then skip to year 10. Now our annual premium, like I said, is $100,000. Okay, great. Of the $100,000, 60% or $60,000 is going to go to that paid up additions rider. And how the paid up additions rider works is you put in $60,000, you'll get just about $60,000 in cash value or equity or cash in your life insurance contract to be able to access. In the whole life portion, 40% of the premium, or the remaining $40,000, we're going to put into what's called a base premium, or a whole life portion in the policy. Now that $40,000 is going to produce maybe $2,000 or a couple thousand in cash value, and your total cash value increase that year is $62,000. Now, a few points here. One, you put in 100, have immediate access to $62,000, or about 60% of what you put in. That's pretty good. You're starting up a policy that's going to start working for you, like you're starting up a bank in essence. Going to take a couple years to get going, just like if you were to invest in yourself, or you're investing in education or a property. Takes a couple of years to get going, because you are not only the customer of the company, being a policy holder, but also the owner. Now, there's no death benefit illustrated on this specific slide. We're just looking at the cash values of the policy and the cash. So let's also dive to year 2. Now, keep in mind, at the far right column, annual cash value increase, that's annual, and this won't be cumulative. So year 2, you put in 100. Well, the paid up additions is really going to be dollar for dollar, as in you put in 60, you'll get about 60 again. But the whole life portion, you put in 40, and it's going to increase about $35,000. So much better than year 1, getting more marginally efficient for you. For 95 cents on the dollar, or 95,000 out of the 100 you put in, you have a nice healthy death benefit. You're going to have strong creditor protection. It's going to be growing tax-free for you. You'll be able to borrow against it. You know, there's so many benefits about this policy and how it's an ideal savings vehicle. Year 3, you put in 100,000. Same thing with the rider, 60,000 into the paid up additions rider, $60,000 cash value increase. But look at the base premium, gets a little bit better. You put in 40,000, it's going up 38 for a total of 98,000. Okay, now look at year 4. You put in 100, it's actually going up about 101. Now, the reason I highlight the base premium or the whole life premium in green, because watch what happens in year 5. We now discontinue the paid up additions rider, and we put in $40,000 in the whole life portion, the base premium, and it goes up 45. So in this scenario, you put in $1, it's going up like $1.10 for you. Now, yes, you shift cash in there, it's going to grow for you, and then you're able to borrow against it. And this is like your savings vehicle that's starting to work for you in a tax-free manner that you can turn around and access it. So the annual cash value increase is 45 that year. Remember, this is not cumulative. This is per year. Then year 10, you put in 40, and it's going up 60. So by year 10, you put in $1, it's going up $1.50. So how big of a check would you want to write, and how many times would you want to write it? Now, when you're doing that and it's increasing 50% more than what you're flowing through, it's starting to really work for you after a handful of years and get better and better each and every year. So as you see in the beginning, a little bit less, but as you get a couple years in, it's starting to really work for you. Recapture this cash drag in the beginning and start paying you and working for you more. So if this is something you want to learn more about, you can reach out to me at harper@lifewithleverage.com or go to the website at lifewithleverage.com. Be happy to look at some examples for you, some illustrations, some numbers, go through your questions. At the end of the day, this is an example. It's kind of more off percentages. So if you were to do 50, you would half these numbers. If you were to do 200, you would double these numbers. And the individual who's doing this, whether they're 20 or they're 60, death benefits might be all over the place, but the cash values will be very similar for how we're designing it for infinite banking purposes.